There are three lines buried inside your portfolio, not one. The first one hits when your investment growth beats your contributions for the first time and it lands earlier than most people expect. The second line hits when your portfolio's annual growth beats your entire salary. And when it arrives, it comes with a trap. Most retirement calculators never model. The third line is the original one, the one from before the industry built a business model on top of it. And it's the one that actually decides whether you can retire without quietly panicking every time the market drops 4% on a Tuesday. Most people only ever find out about the first line. They hit it, exhale, and either coast when they shouldn't or pull back contributions at exactly the moment when keeping them produces the highest return of their entire financial life. In the next 20 minutes, I'm going to walk you through all three. The math is going to be simpler than you expect. The story behind why the third one quietly disappeared from mainstream advice is going to be less surprising than you'd like. Let's start with something that took me longer than I'd like to admit to fully internalize. Even spending years surrounded by accountants and lawyers who understood how money actually moves. There's a phase in wealth building where your behavior matters more than your portfolio. And there's a phase where your portfolio matters more than your behavior. Most people spend their entire investing lives in the first phase, not because they haven't saved enough, because nobody told them they crossed into the second. I think of it as an engine swap. In your early years, you are the engine. Your labor, your savings rate, your decision to not buy the car you didn't need, that's all horsepower. The portfolio exists, it earns something, it compounds marginally, but the human engine is doing the heavy lifting. Then, at a specific, mathematically calculable moment, the mechanical engine compounding becomes more powerful than the human one. The engine swaps. Your job stops being generate the fuel and starts being don't break what's running. There are three moments where this swap accelerates. Each one is different. Each one requires a different response. And most retirement advice you've ever encountered only covers the first one, at best. Stay with me, because the third crossover comes with a tax trap that doesn't show up until your 70s. And by then, you've had decades of opportunities to quietly diffuse it. Here's the part most people miss, even after they learn about the crossover concept. All three lines exist simultaneously inside your portfolio right now, and they are almost certainly at different distances from where you are standing. Knowing which one you've crossed and which one you're actually chasing changes every decision downstream. In a few minutes, I'm going to show you why the math behind the 4% rule has been operating more like a business model than a retirement tool. But first, here is why most people who technically cross over still get this wrong. Crossover one is the one the personal finance internet loves. The concept that shows up in articles about coast fire, about when compounding takes over, about the magic of letting your money work for you. The mechanics are simple enough to fit on a napkin. At some point, the growth your portfolio generates in a year exceeds the contributions you made to it that year. The engine starts doing more work than the operator. The math. Take your annual investment contributions and divide them by your expected long-term return rate. If you're contributing $20,000 a year and assuming 7% returns, you need a portfolio of roughly $286,000 for annual growth to equal annual contributions. Past that number, every year you hold, the gap between what you add and what compounding adds widens. Now, you'll see a rougher version of this floating around the 20 times rule. 20 times your annual contribution is comfortably past the first crossover line. 20 times $20,000 is $400,000. At 7%, $400,000 generates $28,000 in growth, 40% more than your contribution. That's not the exact line. It's a cushion above it. And the cushion matters for reasons I'm about to explain. Because here is what happens in real time when you cross this line. A significant percentage of people feel it and think they've arrived. They haven't arrived anywhere except a new phase of the same journey. The mistake that follows is either stopping contributions or quietly letting them drift downward, and this is the most expensive behavioral error in the entire wealth building playbook. Because contributions at this stage have the highest return on effort of your entire financial life for one specific reason. Employer match. If your company matches 50 cents on every dollar you contribute up to a certain percentage of your salary, that match is a guaranteed $50 to 100% return on those specific dollars. There's no investment vehicle that replicates that. Not index funds, not real estate, not alternatives, nothing. Stopping contributions to let the portfolio run means voluntarily walking away from the only guaranteed return you will ever have access to. That is not optimizing. That is just leaving money on the table with a complicated sounding justification. There's a second reason stopping is dangerous that doesn't get airtime. The crossover line is not a fixed threshold. It moves with the market. A 20% correction can push you back below crossover 1 in a single year. If you'd pulled back contributions in the year before, you've now lost two compounding advantages simultaneously: the growth that was keeping you above the line and the cheap share prices during the drawdown that would have rebuilt the buffer faster than anything else could. There's a third reason, and it's purely about human wiring. The moment savings stop, the spending baseline tends to rise to absorb the difference. It's almost mechanical. The money that was going to the brokerage suddenly goes toward a slightly nicer car, a slightly longer vacation, a kitchen that didn't technically need renovating. Lifestyle expands to meet income, and now the portfolio that used to be enough for your spending level isn't because your spending level just changed. You've moved the target while claiming you already hit it. So the lesson on crossover 1 is this: it means you can breathe. It does not mean you can stop. The engine swapped. Your job is to keep supplying fuel while the new one builds momentum. This is where it gets really interesting, because crossover 2 is the one that most people mentally blur into retirement eligibility, and the confusion has cost people years. Now, before I get there, in a few minutes, I want to show you exactly how the income-based structure of your portfolio can get you to financial independence with a smaller number than you think you need. But first, let's talk about why peak balance is not the same thing as a real crossover. Crossover 2 is the moment your portfolio's annual growth exceeds your annual income from work. Your money is making more than you are. Functionally, this is the first moment where labor becomes mathematically optional. You don't need the paycheck anymore, in theory. At 7% returns, you need roughly 14 times your annual salary to cross this line. A $70,000 earner needs a $1 million portfolio. 7% of 1 million is 70,000. The portfolio replaced the salary. A $150,000 earner needs the line to sit closer to 2.1 million. Higher income, bigger number. The scale is linear. By the way, if you're finding this useful, hit subscribe. Otherwise, YouTube's algorithm may never surface my videos to you again. Now, here is the trap. And this is the part that makes crossover 2 genuinely dangerous if you treat it as a finish line rather than a checkpoint. Growth is a long-term average. It is not a 12-month guarantee. It is not a decade guarantee. Consider anyone who crossed this second threshold in 1999. $1 million, $70,000 salary, growth exceeding income. The math lined up, the engine was running. A lot of people looked at that and thought, I could stop working. Then the decade that followed happened. From January 2000 through December 2009, the S&P 500 delivered an annualized total return of negative 0.95%. Not a rough quarter, not a rough year, a rough decade. The only other decade in the entire index's history to produce a negative total return was the 1930s, the decade of the Great Depression. That's the company the 2000s kept. The decade included the dot-com collapse, the September 11th attacks, and the 2008 financial crisis. The NASDAQ peaked at 5,048 in March of 2000, then fell 78% to its trough in October 2002. The S&P partially recovered, then cratered again in 2008. If you had retired into January 2000 with a $1 million portfolio and were living on the assumption that 7% growth would sustain you, your actual growth for the decade was just under zero. What you thought was income was principal drawdown. And you wouldn't have known the difference until the statements told a story you couldn't argue with. Here's what makes this psychologically brutal. Nobody who crossed crossover 2 in 1999 knew they were crossing it at the exact wrong time. They looked at their statements and saw a peak balance. Peak balance feels like safety. It feels like evidence that the math worked. What it actually was, sometimes, is a high watermark that won't return for over a decade. $1 invested in the cap-weighted S&P 500 at the end of 1999 was worth 91 cents by the end of 2009. You didn't just tread water, you actually lost ground. You think the problem is the size of the portfolio, but actually the problem is the structure. A high balance without a durable income structure is a peak balance masquerading as a real crossover. These are two completely different things. And the retirement planning industry, which built its advisory model on portfolio balance and 4% withdrawals, tends to conflate them regularly. This is why the question changes at crossover 2. It stops being, did I save enough, a balance question, and starts being, is my income structure stable enough to actually retire, on a completely different question requiring a completely different answer. That income structure question is exactly what crossover 3 was designed to solve. And it existed in the literature 30 years ago, before it got buried. Here's what I built for readers who want to take this from understanding to actually executing. Knowing these numbers and actually building a system around them are two very different things. Most people go through their working years watching the balance climb, updating the spreadsheet every quarter, and never actually stress testing the question, what happens if the market drops 40% in year 1 of retirement? The 50 years of actual retirement data I dug into while writing the exit code pointed at an uncomfortable answer. Most retirement calculators assume average returns in a linear sequence. Most actual retirees experience returns in a specific order, and the order of returns matters more than the average. I built the exit code to answer the structural question, not the balance question. It's 8 chapters of research, no filler. No filler dressed up as frameworks focus on the mathematical architecture of an exit from the workforce that doesn't require the market to cooperate in year 1. The 2 elements most directly relevant to this video, the dynamic withdrawal method, which replaces the static 4% assumption with a system that adjusts based on what the market actually did rather than what it was supposed to do over 30 rolling years, and what I call the lazy portfolio, a historically documented approach built on 50 years of data that has outperformed active management over rolling 30-year windows, designed for people who would rather not spend their retirement monitoring tickers. Both are in the book alongside what I call the sequence of returns buffer, the specific cash reserve structure that I think matters more than raw portfolio size for most people in the 5 years before they stop working. You can get the whole thing for less than a dinner out through the link in the description. Every year this decision gets delayed, it costs something. Not in marketing urgency, in compounding. Now, back to crossover 3, the one that came first. And I want to introduce you to Marcus before we get into the mechanics, because Marcus is going to make this feel concrete. Marcus is 47 years old. He's a software engineer in Austin. He's been maxing contributions since 26, lived below his means for most of his career, and by 2022, he had a portfolio at roughly $1.3 million. He earns $92,000 a year. At 7%, his portfolio was generating about $91,000 in annual growth. By any reasonable definition, he was approaching crossover 2. His money was nearly keeping pace with his salary. Marcus did what a lot of people do at this stage. He started mentally deprioritizing the aggressive contributions he'd been making in his 30s. Not stopping entirely, he kept contributing enough for the employer match. But the extra savings he'd pushed hard on for 15 years started feeling less urgent. He felt, as he put it to me, like he'd made it past the hard part. Then, 2022 happened. His portfolio dropped to approximately $950,000. Not catastrophic, not a crisis, but enough to push him back below crossover 2. The engine had temporarily swapped back. And the years he'd spent slightly coasting meant the recovery trajectory was slower than it would have been if he'd kept pushing. Marcus is fine. His portfolio recovered. He's still working. But he made the classic mistake. He confused a high balance with a durable income structure. And that confusion is exactly what crossover 3 is architecturally designed to prevent. Crossover 3 is the original definition, not the one the financial planning industry handed you, the original one. It came from a book called Your Money or Your Life, written by Vicki Robin and Joe Dominguez, published in 1992. The book defined the crossover point as the moment when monthly investment income crosses over monthly expenses. Not portfolio size, not annualized growth rate, not 25 times annual spending. Monthly income from assets crossing monthly expenses. The original question wasn't how big is my balance? The original question was, does my portfolio pay me a reliable, recurring stream of income that covers my bills without me having to sell anything? Here's why that distinction matters mathematically. If you spend $40,000 a year and you hold income-producing assets yielding 5% annually, you need $800,000 in capital to cross that line. At a 7% income yield achievable through a combination of dividend stocks, REITs, bonds, and notes, you need $571,000. Compare that to the 25 times rule, which requires $1 million for $40,000 in annual spending. The income-based crossover gets you there at $800,000, or in some structures less. That's a meaningfully smaller target. And the mechanism is completely different because you're never touching principal. The income pays you, the principal stays. Now, let me tell you what happened to that original framework. 2 years after Your Money or Your Life was published, a financial planner named William Bengen published a paper in the October 1994 issue of the Journal of Financial Planning. The paper was called Determining Withdrawal Rates Using Historical Data. Bengen ran historical simulations back to 1926 and found that a retiree who withdrew 4.1% of their portfolio in year one, he rounded it to 4 and adjusted that withdrawal for inflation every subsequent year, had historically never run out of money over a 30-year period. That became the 4% rule. Bengen himself has since said, as recently as summer of 2025, in press surrounding his new book, that the 4% figure was always designed as a worst-case scenario, a floor for the most conservative retirees imaginable. He has since updated his own analysis to 4.7%, and in his latest work argues that 5% is achievable with the right asset allocation. The 4% rule, in his own words, was never meant to be a cookie-cutter golden rule. That's the inventor talking. But the industry grabbed 4%, simplified it to 25 times your annual spending, and built an entire advisory framework on top of it. And here's where the incentives get interesting. As of December 31st, 2024, there are 103,093 certified financial planners in the United States, per the CFP Board's own reporting. According to the 2024 Kitces research on how financial advisors do financial planning, 92% of advisors incorporate assets under management fees in some form. 86% use AUM as their primary revenue source. The median AUM fee at the $1 million portfolio level is just over 1% per year. Here is the math from the advisor side of the desk. If a client holds $200,000 in a managed portfolio at 1% per year, that's $2,000 annually in fee revenue. Over 30 years, with a portfolio growing at 7% gross, a 1% annual fee drag reduces the ending balance from approximately $1,522,000 to approximately $1,148,000. That's $374,000 of compounding that never happened, not because of bad investment selection, because of the fee structure. Now imagine a client who wants to move $200,000 out of the managed portfolio into a rental property, a CD ladder or secured mortgage notes, income-producing assets outside the advisory relationship. From the client's standpoint, those $200,000 are working. From the advisor's standpoint, they just stopped generating a fee. $2,000 per year per client, gone. Multiply that across a book of 300 clients, and the economic incentive to steer clients back toward the accumulated portfolio, the one generating the fee, becomes structurally visible. There's a moment that happens in a lot of financial planning offices when someone asks, but what about just living off dividends and rental income and not selling anything? And the advisor nods and maybe says, that's an interesting idea. And then the conversation somehow drifts back to the portfolio and the allocation and whether you should adjust your equity mix. Not because the advisor is dishonest, because the advisor's entire practice is built around a specific framework, and the income-based crossover lives outside that framework. Here's the thing though, dividend-paying stocks pay you when the market drops. Bond coupons pay on schedule regardless of what the equity index did. Rent keeps coming in during market drawdowns. Secured note payments are contractually fixed. These are income streams that survive exactly the scenario that destroys crossover 2, a lost decade where growth goes flat for 10 years and your theoretical growth income turns out to be principal erosion in disguise. This is the only crossover that doesn't break during a period like 2000 through 2009. There's something worth adding about Marcus here, because it resolves his subplot in a way that makes this practical. Marcus sat down after his 2022 correction and asked a question he had never thought to ask before. Not, what is my balance? He asked, how much did my assets actually pay me last month? Dividends deposited, interest received, any income that hit an account without him selling anything. The number surprised him, about $2,200 per month. His monthly expenses sit around $3,800. He's at roughly 58% of crossover 3. He always thought he was much closer to done because his balance said the math should work. But when he looked at the actual income side of the engine, not the value, the income he was running on a partial engine, not a complete one, that's the dashboard switch. Stop measuring net worth as the headline. Start measuring monthly income from assets. Net worth is a number that moves every day the market is open. Monthly income from assets is the budget. It's the actual cash flow you're going to live on. If you can answer, how much did my portfolio pay me this month? Dividends, interest, rent, note payments, any income that arrived without you selling anything, then you have crossover 3 in your sights. Your financial advisor's dashboard almost certainly does not show you this number. It shows balance, allocation, and return percentage. Why doesn't it show monthly income from assets? Because then you'd stop chasing the balance. That's not what advisors say, obviously, but it's the structural logic underneath. Now, here is the tax dimension of crossover 3 that most people discover somewhere between their late 50s and early 70s, which is approximately the worst possible time to make a discovery. There's a specific kind of conversation that happens at financial planning offices when a client turns 73 and asks, wait, so they just take it whether I need it or not? And the advisor says, yes. And the client says, what if I don't want to? And the advisor says, it's the law. And the client stares at the wall for a long moment, reconsidering approximately 40 years of decisions. That's the required minimum distribution conversation. Under Secure 2, which passed in December 2022, traditional IRA and 401k owners must begin taking required minimum distributions starting at age 73. The IRS mandates annual withdrawals from pre-tax accounts, taxed as ordinary income, whether or not you actually need the money. And one single number on that RMD calculation can simultaneously move 3 separate bills. A large RMD pushes your combined income above the threshold where Social Security benefits become taxable. Up to 85% of your Social Security income can be subject to federal income tax depending on your total income that year. The same RMD can trigger IRMA, the income-related monthly adjustment amount on Medicare Part B and Part D premiums. These surcharges run hundreds of dollars per month per person stacked on top of your base Medicare costs. And the same RMD can push you into a higher federal tax bracket on capital gains you otherwise would have paid 0% on. One number, 3 bills, all higher. The solution isn't complicated, but it requires acting well before age 73. Roth conversions in low-income years before RMDs begin. Redirecting contributions away from the pre-tax pile once the employer match threshold is met, putting future dollars into Roth or taxable brokerage accounts instead of compounding the future RMD problem. And building income-producing assets inside taxable accounts that generate qualified dividends at 0 or 15% tax rates rather than ordinary income at 22 or 24. People who navigate crossover 3 cleanly aren't smarter than the ones who hit the RMD trap. They just thought about the income structure earlier. The structure question is a 20-year project. The balance question is a number you check quarterly. Most people spend 20 years on the second one and discover too late that the first one was the one that mattered. Let me make this concrete with a realistic scenario. Dana is 51 years old. Project manager, earns $85,000 a year. She started investing at 31, has $800,000 in a traditional 401k, and approximately $90,000 in a taxable brokerage account holding index funds. Monthly expenses, $4,200. The surface math looks decent, but Dana's retirement income plan, as currently structured, assumes she'll sell shares under the 4% rule. 4% of $890,000 is $35,600, about $2,900 a month. Her monthly expenses are $4,200. She'd be running a $1,200 monthly shortfall before accounting for taxes on every withdrawal. She plans to take Social Security at 62 to bridge that gap, which permanently reduces her benefit by roughly 30% compared to taking it at 67. She doesn't know about the IRMAA thresholds, and her pre-tax balance is going to be meaningfully larger by the time she's 73. Run the parallel version of Dana. Same total savings, same timeline. But she redirects the conversation at 51. She stops adding to her pre-tax 401k beyond the employer match and starts routing additional contributions into a Roth IRA and a taxable brokerage she's building around income-producing assets. She builds a 3-year CD ladder inside the taxable account, current yields around 4 to 5% on shorter duration CDs, generating about $2,800 annually in interest income. She uses $15,000 to participate in a secured private note, paying 6.5%, another $975 per year. She shifts the taxable brokerage's index fund holdings gradually toward dividend-focused funds yielding around 3%. By 58, Dana's income-producing assets are generating roughly $1,400 monthly without selling a single share. Her monthly expenses haven't changed. She's at 33% of crossover 3. She's not retired, but she's watching a number, the income number, rise toward a specific target. She knows what crossover 3 looks like, and she knows how far she is from it because she's measuring monthly income, not just balance. When Dana eventually reaches the crossover, her RMD problem is also smaller because a meaningful portion of her assets are in Roth and taxable accounts, not pre-tax. The forced withdrawal at 73 is manageable. Her Social Security timing has flexibility because she's not desperate for the money at 62. The structure did the work, the balance never could. So 3 crossovers, 1 engine, 3 swaps. Crossover 1, your portfolio growth beats your annual contributions. For a $20,000 a year contributor at 7% returns, this lands around $286,000. Once you're there, you can breathe. You cannot coast. Keep contributing, minimum to the match. The engine swapped, but it still needs fuel. Crossover 2, your portfolio growth beats your annual income. For a $90,000 earner, that's somewhere north of $1.2 million. Work becomes mathematically optional. But peak balance is not a real crossover. Anyone who thought they'd cross this line in 1999 and was planning to live on growth discovered, across a lost decade of negative annualized returns, that their growth-based income had silently become principal drawdown. Structure beats size, always. Crossover 3. Income from your assets covers your monthly expenses. The original definition, the Vicki Robin version from 1992, before the industry decided it was more profitable to measure portfolio size than income yield. For $40,000 in annual spending, you can reach this at $800,000 in income-producing capital at 5%, or considerably less at higher yields. The threshold is lower, the mechanism is more durable, and the tax path through it, done correctly, is also cheaper. 3 moves from this. 1, if you've crossed crossover 1 but not 2, stop asking how much do I have and start asking what does my portfolio actually pay me without selling anything. That question changes the allocation decisions downstream, and the answer tells you the real distance to crossover 3 far more accurately than your balance statement. 2, if you're within 15 years of your target retirement date and the majority of your assets are in pre-tax accounts, model your RMD at age 73 before it arrives uninvited. Take the current balance, project it forward at a reasonable growth rate, divide by the IRS life expectancy factor, and stack that number on top of your expected Social Security income. If the total triggers IRMA, Social Security taxation, or bracket creep on capital gains, You have a window right now before the mandatory withdrawals begin to do Roth conversions in lower income years and shrink the future pre-tax liability. Every year you delay this calculation, the pre-tax account grows and the future conversion becomes more expensive. 3. Build a dashboard that measures monthly income from assets, not just portfolio balance. A spreadsheet, a simple tracking tool, anything. Log every dividend, every interest payment, every rent deposit. Watch that number rise. Once you're tracking monthly income instead of monthly balance, you've made the psychological shift from how big is the number to how much does it pay. That shift is the clearest sign that you've started thinking in terms of the third crossover. And the third crossover is the only one the market can't take back. Lazy investing built more fortune than crypto memes. And if you want a parting thought, the framework that most of the retirement planning industry handed you to decide when you're done was invented in 1994, calibrated for a 50-50 stock bond portfolio, designed as a worst-case floor for the most conservative retiree imaginable, and has since been revised upward multiple times by its own inventor to 4.7 and even 5%. The industry took a worst-case floor, called it a rule, named it after the number, and sold a business model around it. That's what you were given as the definitive answer to one of the most important financial questions of your life. A floor, wearing a rules clothes, inside an advisor relationship that earns more when you accumulate more and has limited incentive to point you toward the income structure that requires less. The engine is there. Most people just never get told when it's ready to run on its own.